Hey guys, welcome to the channel. Today I'm going to be giving you my full beginner's guide on how to use chart patterns. Chart patterns are the language of a market. Now imagine yourself in a foreign country and you don't know how to speak a single word of the language. How hard would that be? You wouldn't be able to buy food, you wouldn't be able to go around, use transportation, anything like that. That would be so hard. The same thing is true when it comes to trading. If you know how to read these patterns in the right way and read them really quickly, you'll be able to make so much money in the stock market, and this will put you ahead of the competition. All right, so today we'll be covering what is a candlestick. I'll be teaching you everything about what does the high mean, what does the low mean, what are the wicks, and how you can read these candlesticks. I'll also be teaching you why candlestick patterns are important and why they are able to make you so much money in the markets. So next I'm gonna go over 7 very powerful chart patterns that I have used a lot and that have made me a lot of money in the markets. The first is gonna be a triple bottom. The next is ascending scallops. The third is head and shoulders. The fourth is gaps. The fifth is bull flag. The sixth is bear flag. And the seventh is a cup and handle. I'm also going to be sharing a little bit on how you can use these chart patterns to predict market movements and how you can use these to set your price points on where you're going to either exit for a loss or exit for profit. All right, so without further ado, let's hop into it. All right, so what is a candlestick? Here in this picture on the right, we can see different candles. One is green, one is red. The green one represents an increase in price, the red represents a decrease in price. So the real body, or the main part of the candle, is the difference between the open and the close. The amount the stock went higher beyond the real body is called the upper shadow, and the amount it went lower than the real body is called the lower shadow. Now, if the candle is green, it means that the open was lower than the close and the stock went up in price. If the candle is red, then the stock decreased in price. Now, there's more to be said about candles, but this is just a very basic course, and this is about all you need to know about a candlestick. Now, there are candle charts and there are also line charts. Candle charts are much better in being able to see market structure and being able to predict these market movements, as opposed to lines, which don't really give you that much information. Candles are so powerful. Let's get into why they are. So why are these candlestick patterns so important? The same candlestick patterns tend to repeat themselves. So if you see a cup and handle on one chart, you're gonna see a cup and handle on another chart, and they're gonna be about the same, and you're gonna be able to predict price movements based off of history. And that's the most powerful thing about trading and investing, is you're using history in the stock market to predict future price movements. Candlesticks also consistently provide early signals on trend changes or trend reversals. And in the next 7 patterns that I'm going to show you, we're going to differentiate them based off of either a continuation or a reversal. These 7 candles that I'm going to be covering recur frequently and are significant enough that you should know them by name. Knowing their names allows you to spot them more easily and assess their implications. If you can name these 7 patterns, you're going to have a massive advantage over those that can't. So the thing about trading the markets especially is, yes, it is a matter of timing. If you're late on a move, you don't have as much profit potential, and that also puts you significantly above your stop loss in most cases, which can make you lose a lot of money if the trade decides to go in the opposite direction that you're anticipating. And also, failure to spot these candles can lead to costly trading errors. I know early in my trading career, I did not know how to read these chart patterns. I was just going in it blindly. As I mentioned in earlier videos, I had this gambling mindset, and I didn't care what the chart showed me, as long as there was hype behind it, as long as I just felt this emotional tug towards the stock that I was investing in, then I would get in that position. And I lost so much money from that. So the most important thing is to recognize these chart patterns as they're forming, be able to create your lines to show you exactly what these chart patterns are, and then predict where the price will move based on these chart patterns. So the first one we're going to go over is called a triple bottom. This is bullish and it shows a sign of reversal. So at the bottom of a downtrend, if price action hits 3 points all around the same range and then rallies up, that's called a triple bottom. So pretty much a triple bottom is 3 lows at the same price range, forming a strong support level at the bottom of a downtrend. So to confirm a breakout, we want to see an increase in volume, as you see by these arrows down here. As the triple bottoms are being formed, you're going to see a decrease in volume, but as you come to that third bottom, or sometimes it's a second bottom, sometimes you can have a double bottom, and that's a powerful indicator as well, but a triple bottom is even more powerful. But anyways, as you come to that third bottom, you're going to see an increase in volume, and that can be the momentum that the stock needs to break above that resistance level that it's created. So to find your price target, you're going to add the range between the support created by the 3 bottoms and the resistance level that it's come up to touch, and you're gonna add that to the breakout. So essentially you're gonna double that amount. So next we come to the ascending scallops pattern, and I absolutely love this one. It's made me a lot of money, specifically on Shopify and Amazon, which have had similar patterns. When they've been on their uptrend, they've created this scallop pattern, and it's been an amazing way to make money on, yes, these are some more expensive stocks, but you can also find cheaper stocks that also have the same pattern as well. So it is a bullish pattern, and it's a continuation pattern. What it looks like is an upside down J, with price ascending to a high and declining slightly before ascending back up again. So for a breakout indicator, you want to see an increase in volume. So as price is moving up, you're going to see an increase in volume. Then volume starts to taper down a little bit when the J is being formed, the bottom of the J is being formed, and then volume will spike up again as it breaks out to the upside. So we also want to have a break above that rounded top, and that will confirm our breakout to the upside. So our price target is the measurement between the high and the low of the scallop pattern, and we're going to add this exact same amount to the breakout. So the next pattern is a head and shoulders pattern. This is one of the most common, but it's one of the most tricky as well. I know when I first got started, all over Twitter, people are saying, oh, this is a head and shoulder pattern, head and shoulder pattern. But when you look at it, it was weird because all their head and shoulder patterns look different. So a head and shoulder pattern may be evident for one person, but not evident for the other. So yes, it can be a very powerful tool if a lot of other traders are able to recognize this pattern as well, but it could be also a little problematic. So anyways, this is a bearish pattern, so that means that the stock is going down. It's also a sign of reversal and typically happens at the end of an uptrend. So this typically is a three-peak formation, with the center peak being higher than the others, with the neckline functioning as support for the head and shoulders. So for a breakout, we are looking at increased selling volume with a close below the neckline. So to find our price target, we're going to measure the first low of the neckline, as you see by this arrow right here, and we are going to measure that from the top of the head and subtract that from the neckline on the breakout to the downside. So that way you're able to have a very good price target and you'll be able to get out of your position in time. One thing to note is you're also going to see typically increased selling pressure, so increased volume, and if you turn on the volume indicator, that will look like red bars that are increasing in height as you start to approach the break of the neckline to the downside. So next we have gaps, and this is non-directional. It can be a reversal kind of pattern. So pretty much what it is a gap up or down in price. Price action usually takes 1 to 2 weeks to fill these gaps that are created. Sometimes you can have a breakaway gap to the upside, you can have a breakaway gap to the downside, and sometimes you could just have a normal gap where it's just a small gap in the chart that price action will fluctuate and eventually come down to fill. So a breakout indicator is a close above or below the gap in the opposite direction. So just to note, the high and low of a gap should be treated as support and resistance levels. If you don't have any clear and defined support and resistance levels in your chart already, and by the way, if you haven't watched that, I have a 2-part video series. Part 1 is linked right up above, and it's how to draw your support and resistance lines. That's going to be so powerful when you're using that in combination with these chart patterns. Anyways, if you don't have clear support and resistance levels around the gaps, these gaps can function as support and resistance. A few videos back, I talked about how on the daily chart, UPS created these gaps to the upside. However, when price fell, it actually came down to the top of that gap, which acted as support, and it bounced off of that. So these can be very powerful indicators that you can place your buy orders at when price starts to come down to fill the gap. So next we have bull flags. So a few days ago on my Instagram, I posted about Shiba. This is pretty much a cryptocurrency that blew up because it's pretty much a meme, and it just got a lot of hype from Elon Musk. It got a bunch of buying volume and price went up. So I guess a reasonable thing to assume is that a weird thing such as a meme coin doesn't follow chart patterns. Well, you can use chart patterns all across the board. Whether you're trading cryptocurrency, whether you're trading stocks, you can use these chart patterns wherever. So on that play, Shiba was making a bull flag. So overnight from about like 10 p.m. until about 3, 4 in the morning, it was creating this bull flag. So pretty much it just broke out to the upside and it hit our price target, and a few of my followers who are on it, as soon as I posted it, were profitable, as well as I. Anyways, this pattern is a short downwards channel following a steep upwards move. This steep upwards move is called a flagpole, and this short downward channel is called the flag. Flags last anywhere from 2 to 4 weeks on a daily chart. However, these can definitely be used on the smaller time frames as well. I use use it when I'm day trading. I use it on the 5-minute chart. When I alerted Shiba the other day, it was on the 30-minute chart. So you can really see these all across the board. But if you're looking at a bigger move, you're going to definitely see these on the day chart, and you should expect this flag to form for between 1 and 2 weeks. So to confirm a breakout, we want to see a close above the upper trend line of the flag. We also want to see an increase in volume. So when I called out Shiba, not only did we have a close above the downtrend of the flag, we also had a massive spike in volume, which was able to rally that stock all the way to the upside. Now, how can we measure a price target? So what we're going to do is we're going to measure the length of the pole, and we're going to add that to the breakout. If the length of the pole was $10, we're going to add that to the breakout, so our price target will be $10 above the breakout price. Next, we have a bear flag. Pretty much the same thing, just the opposite. So this is a bearish continuation pattern, and it's a short upwards channel, or it could be a horizontal channel as well, following a steep downwards move. These flags last anywhere between 2 and 4 weeks on a daily chart as well. And for a breakout, you want to have a close below the lower trend line of the flag. So to measure our price target, it's exactly the same. We measure the length of the pole going to the downside, and then we add that to the breakout to the downside after it's broken out of the flag. So lastly, we have our cup and handle formations. These are amazing. I've made so much profit off of these. However, these typically last a little longer, especially when playing on the day chart. And these can take anywhere between a month and 2 months to form. So this is a bullish continuation pattern. It has a short handle on the left with a cup formation lasting at least 5 to 6 weeks. So to confirm a breakout, we want to have a close above the top resistance line of the cup with an increase in volume. So to find our price target, we're going to measure the price from the top line of the cup or the lip of the cup to the bottom of it. We're going to add that to the breakout. So how can you use all this chart pattern knowledge? I just gave you 7 amazing and very powerful chart indicators that will help you to massively increase your money if played right. But how can we use this, and how can we mitigate risk? Even though you may be able to anticipate the measured move of the stock, always be sure to take your profit at predetermined percentage levels. When I am day trading, I'm looking for a 10% profit and I'm out. If I'm in a $100 contract, I'm only looking for $10 and then I get out. I don't care if the move is supposed to be an extra $10 more, an extra $20 more on the price chart. I'm out at 10%. So you need to be really strict in taking those profits, because oftentimes you'll start seeing money come in, you'll be in the green 20, 30, 40%. All of a sudden the rug will be pulled out from under you, and there goes all your profits, and you end up selling in the negative. So just make sure that you take profits at predetermined percentage levels. So obviously if you're buying shares, chances are you're buying quality companies, right? Because I taught you all how to assess a balance sheet to look for quality companies that won't go bankrupt. So if you're investing, pretty much you're going to be looking to take profits. I recommend at 30 to 50%, but that's up to you. And this all depends on your trajectory of the stock. Also, don't be so sure of your charting that you ignore the warning signs that the stock is moving in an opposite direction. This is such a rookie mistake. You can get so passionate about learning the charts, learning everything there is. Your support and resistance lines are on point. Your chart patterns, you know all of them. You know these 7 like the back of your hand, but the danger is when you start being overconfident in these levels and you don't see the warning signs that the stock is going against you. I remember playing Square a few months back. I lost $8,000 on this trade. I told a few friends about this. This was my worst loss to date, and it was just within a matter of hours. And the reason why is because I had charted this the night before. I had talked with a few of my friends who were really, really good at charting, and they were like, man, this is perfect. You found an amazing stock. This is a gem. Bad news came out the next morning. The stock absolutely tanked. But I just ignored this and I just kept going, and I ended up losing pretty much all of my money in that trade. So anyways, be careful. Just make sure you look for the warning signs that the trade's going against you. Also, the stock market will do what it wants to do. That's what I talked about already. Don't think that you have control over it. Don't think that you're going to pray and the stock is going to magically reverse. You don't have any control over it. There are different people in the stock market every day who have different emotions, who have different plans, who see different things. So just be aware of that and know that it's a volatile game. But if you're able to be on top of it, recognize these chart patterns, you're going to come out really profitable. Also, this chart pattern knowledge is a leg up on other traders or investors, so take time to study and memorize these patterns. So what I recommend is you can either go back in this video, take screenshots, print them out, do whatever you want with them. You can also make flashcards where you draw out these chart patterns, and that will be so helpful for you to memorize these. Also, feel free to reach out to me at Trader Isaacs on Instagram, or comment down below with chart pattern questions, or if you'd like me to check your charting. I'm always available to do this. Send me a screenshot screenshot of your chart. I'll check it for you, and any questions you have regarding these chart patterns, I'd be happy to answer them. Also, don't forget to practice. So I recommend creating an account with TradingView, and it's so customizable. You have so many different lines, you have different chart patterns on there. It's going to be a really amazing way for you to start practicing how to recognize these patterns before you actually have real money on the line. Anyways, guys, that's my chart pattern video for you. If you did enjoy the video, please drop a like, hit that subscribe button, and don't forget to turn on that notification bell so you don't miss any time-sensitive content. I look forward to seeing you all in the next one. Peace.